and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. And today we're going to be talking about equity release. Again, equity release used to be a bit of a dirty word, but now I think it's becoming more and more common with people to say, should I be thinking about it? Is it drawdown 2.0? Or with inheritance tax, is it something that's worthwhile thinking about to reduce someone's estate?
Yeah, I mean, I think at its root, where equity release can come in is for many retirees, although pension, they see it as their biggest asset, it's not actually the biggest asset that they hold. Most people's biggest asset is their home, and they'll have paid it off over the course of 30, 40 years sometimes now with mortgages. And it's something that they can't always access. We always call it, I mean, you could be asset rich but cash poor, because you may not have that much flexible income, but you might have 400,000-500,000, sometimes more in a property that you can't access.
Of course.
So equity release essentially could be something where you can essentially harness the value of your property to help you now, as opposed to waiting for you to pass away and only having you sort of the beneficiaries of your will being someone that benefits from your property.
Yeah, definitely. And I think this is a bit of a psychological tough one as well, because people often say, we've spent our lifetime trying to reduce our debt and pay off our mortgage. So the idea of then taking on debt in retirement seems completely counterintuitive. But I think for the reasons that we'll talk about in the episode, it can be really used cleverly and it can be used well to help people with that idea of, if you are asset rich and cash poor, you then could say, okay, am I forced to downsize and move? And what equity release can do is it can say to someone, actually, you can still live in the property you want to, but you can still get the benefit from a percentage of that equity, and you can use it either for yourself as income or to potentially gift to try and reduce your estate.
Yeah, again, with quite a lot of the products and advice that we speak about, I think equity release is something that's really benefited from higher regulation since the early 2000s. There were previously, it might be the case where people might have a stigma against it, where people have got into negative equity, really large interest payments that they don't know about or the beneficiaries didn't know about. But we'll speak about sort of how some of that's been solved over sort of more recent years. I mean, just in 2024, there was 2.3 billion released from properties, essentially turned from illiquid assets to liquid assets in 2024, which can do a lot of good and allow a lot of people to enjoy themselves in the present, essentially. But yeah, in today's episode, we will be sort of explaining what equity release is, why it can be good, why it works, why it sometimes doesn't work, and trying to sort of pick some points up there. To start off with, Matthew, I thought, because it is sort of a new concept that we've not looked at, I thought we'd just make the jargon buster equity release in general.
Yeah.
Do you want to start off by just explaining a little bit of what it is?
Yeah, so I think at its simplest nature, equity release is taking some of the value of your property, and depending on your age and the value of your property, you can release a certain percentage of that. There's different types of products that we'll touch on a little bit as we go through. I know when I did my equity release exam, there was a few products which I was like, okay, I can see why these have had bad press in the past, because they can really get into bad circumstances. And there was other products which you could say, okay, I can see how they could work, but because they're almost in that same umbrella, people get a little bit sort of lost in what they are. Equity release in general is regulated by the FCA and it's overseen by the Equity Release Council. And as you mentioned there, it's something that's actually helped to make this area a bit sort of clearer and a bit easier for people to navigate. That being said, I really don't like the idea of people advertising equity release on the telly. It's something that is a high-risk transaction, and therefore someone does want to go through regulated advice to ensure that they're picking the best provider, the best product, and the best solution for them.
Yeah, I don't think it's as simple as making a contribution to an ISA or a contribution to a pension.
And
it's something
you shouldn't do it to get a free pen or anything on the telly.
Yeah, exactly. It's something where you have to really think about your goals and objectives, why you're doing it, and also not just yourself in equity release. Make sure that sort of the rest of the family is involved. But we will sort of chat about that. I thought it would be good, first of all, to think about who might consider equity release, where that might be right. I mean, one thing that sort of I think is maybe Well, actually, we'll start with the obvious ones first. A lot of people might use it where they don't necessarily have the capital available to themselves to enjoy the retirement or to make some changes to the home that they need to change. And that might come from a space of they're wanting to make home improvements to make sure that it's sort of ready for sort of a longer retirement, or it might be something that's a little bit more forced where you need to make changes to the home due to an illness or a care need, and that is a lot of the time where that could come in if there's no other assets available, or on sort of the topic of essentially you ran out of flexible income sources and you need money to sort of continue going forward.
Yeah, definitely. I think the income need is that starting point where you almost say, okay, what was my plan? What am I looking to take? And if I've used up something like a pension and you've drawn down on that to a point where you don't have any more flexibility there and you haven't got any more cash or ISAs or anything else to take, you might be sat there with a large property, a large value, and you haven't got liquidity to spend. Equity release is the perfect example. If you don't want to downsize, so if you don't want to sell that house because it's family home or it's got a lot of important things for you, then the idea of releasing a percentage of that to have as liquid cash to spend as income makes a lot of sense.
Yeah, and then I suppose sort of the not newer, it could have always been done, but particularly with sort of pensions come into the estate, and I think a lot more people are thinking about inheritance tax with the bands not going up. That's where equity release could come in as almost a tool to help you reduce down the value of your estate. And the way that this might work, you might be sort of asset rich but cash poor, and you might not have any capital that is sort of liquid and allows you to gift out of your estate. So some people could potentially look at reducing some of or releasing some capital from their property to allow them to gift outside of their estate, be it through sort of the 3,000 gifting allowance or through using some of that nil rate band to get the money outside of the estate while they can. But I think a key bit with that is that the plan needs to be in place, because if you just release equity out of the house and don't gift it away, you're just paying interest on an asset that you already hold, and you're going to continue holding it in your bank account. Yeah,
definitely. And I think some people watching might think it's, seems a bit silly that someone's got lots of assets, therefore they've got inheritance tax liability, and therefore they're looking to take on debt. But essentially that debt sits against the estate. So if you then release the cash, create the debt, if you can then get that debt out of your estate, you are directly reducing that liability. So we've done a few, quite deep exercises looking at inheritance tax for people recently, especially focused on the budget changes and pensions falling into someone's estate. If someone then said, I want to take 200,000 or 300,000 or a large amount of money from a pension to get it out of my estate, okay, that's a taxable event. And how can you do that over multiple tax years? If you haven't got any tax-free cash left, you are restricted with those income tax bands, and it's not a tax-efficient way to do it. But if someone sat there with a large pension and then large properties or a couple of properties, and they're unwilling to sell and downsize, then drawdown 2.0, as we can phrase it, is to say, what can I take from the pension, from the property, via equity release, and then that can create an instant IHT saving by doing it. Yes, there's fees. Yes, there's additional things to think about, because you might not own the whole of your property going forward, but certainly it's a really viable way of thinking about releasing funds and moving through that journey.
Yeah, so moving on to sort of the products that you can look at with regards to equity release. I see there's two main ones, and then maybe one that isn't quite equity release but falls into the same bucket. So the most common one that we see is a lifetime mortgage. You can essentially take these from age 55 and you borrow against the value of your home in the same way that you've borrowed when you had your mortgage to actually build up your home yourself. And you can either take these as sort of lump sum payments or essentially like a drawdown account, they call it. And if you do take a drawdown account, you'd only be charged interest on the bit that you've actually drawn out. And then you can either pay it back as income or income and capital, or you could not pay back at all and you could roll up all the interest and it's only paid back on death. And another thing to note on these, when you're looking at borrowing through sort of a lifetime mortgage, your age will actually depend on how much equity you can release from your property. And I suppose part of that is to protect yourself, because you don't want to run up the interest too far. So if you're only able to take a certain amount at 55, you may be able to take more at 60 or 65 or 70.
And I think one of the things you said earlier is really key to this as well. It's about having the next generation on board. Again, if someone doesn't have the next generation and they're just trying to dip into the property for themselves, okay, that's fine. You know, they can just say, I'm choosing to use this now and stay in the property. But if it's being done as part of an inheritance tax journey or trying to preserve wealth for the next generation, what you don't want to do is try and set a policy away like this or a process away, and then suddenly the next generation say, well, why have we done that? I would have rather had the full house, or I actually didn't need to benefit or didn't need to inherit funds from you, so I'd rather you'd enjoyed it more yourself, for example.
Yeah, I think that's a really important thing, both with general financial planning, but more strictly with equity release, because you need to look at your goals and objectives, but at the end of the day, it's something that will pass down to children and grandchildren, so speak about their goals and objectives as well. Some people might really want to have a family home passed down to them, in which case you could look at some alternatives. You could look at maybe even taking a loan from them. If it is the case, it's not inheritance tax planning and it is something where you are looking at just sort of income, that could be an option. But I think it is really crucial, because people never like surprises, and if they're going through sort of a tough period anyway, if they're going to find out about this when you have passed away, it's just going to make it harder to sort of process and go through the whole thing.
I think 90% of the horror stories you would see about equity release, if you sort of looked in a newspaper or sort of Googled it, would always be from the perspective of the next generation. So I think that's crucial, that you almost say, is it a joined up plan? Do we know what we're getting ourselves into? And like you say, no one likes surprises, so it's having them involved in the journey, definitely.
Yeah. And the other product is a home reversion plan. So this is more often accessible from 60 plus. This is quite different to a lifetime mortgage, where a lifetime mortgage, you maintain ownership of the home and you're just borrowing against the value of a home. A home reversion plan, you essentially sell the property to a provider, and you do that at sometimes a significant reduction to the market value. You still stay in the home rent-free, and you've got a contract there to stay in there until you maybe move into care or you pass away. Sometimes there is a nominal amount of rent there, but it's peppercorn rent a lot of the time. But just to sort of give you a bit of an idea of how that might be structured, you might want to release 40% of the value of your property. So the home reversion plan provider would take a 40% share. Let's say the property is valued at 500,000. Instead of getting 200,000 out of that, they might buy that 40% share for £100,000. So almost a 50%, well, exactly a 50% reduction in the market value. And then when it is sold, the provider would essentially get the full market value. So if it's sold at 600,000, at 40%, they'd get 240 back. So it can be, particularly if you're looking at a home reversion plan and you pass away soon after, it can be a real significant hit to your estate. And equally, the provider wins when property values go up, because then they've got a larger share of your property, and property values over the last 10, 15 years have been going up. So these are very rare at the moment. You don't see home reversion plans often, and it would always be sort of my preference to look down that lifetime mortgage route where you maintain home ownership over something like a home reversion plan.
Yeah, I think I agree. I think, we should make it clear to people who are thinking about equity release, you definitely want to get formal advice. And if someone comes to talk to us about it, again, we've got, colleagues who are specialists in the industry who can provide, really good advice and go through the plans. For me, when I first looked in and did the exam, the home reversion plan is the one that you almost go, oof, you're taking a heavy hit there. So it's, bottom of the pile from a choice point of view. But the lifetime mortgage certainly is something where it feels a little bit more in line with a mortgage that someone's had when they've owned their first property, when they've built up a property, when they've moved house. So that's an element of being something that's a bit more easy to understand and a bit more palatable when you're covering an interest, rather than just feeling like you've given away a percentage of your house at a low cost.
Yeah, absolutely. And the final product that I did want to touch on, this isn't strictly equity release, and it's not governed by the Equity Release Council or overseen by the Equity Release Council. But you could, if you're looking to release some equity from your home, look at something like a retirement interest-only mortgage. And this is very similar, if not the same, as something that you might get if you had a buy-to-let property and you wanted an interest-only mortgage. Generally, they look at sort of a 60% loan-to-value on these type of mortgages, so you could potentially get up to 40% of the value of your home out. And because it's a more sort of traditional mortgage as opposed to an equity release product, you have to meet affordability requirements, and there's a need to pay that interest back. And often there is sort of an upper age where they won't lend to you.
Yeah, I think lots of the high street lenders now are taking pension income into consideration. So again, it could be something that if someone's got a large pension and they're not working, well, actually they can start to use this to allow their mortgage element to go longer and longer into retirement.
Yeah, absolutely.
So when people are thinking about equity release and thinking about when it can be used, I think it's key to remember that it is an expensive product, and a bit like taking out a mortgage, at the point when you're debt-free, would you want to take out a mortgage psychologically? Well, if there's other ways to avoid that, people want to do that. So, we talk to people about using other assets, other savings, and I think that makes complete sense. If someone's got pension income, ISAs, investment bonds, cash, they can be used first for an income need, and they can be used to be spent or potentially use those assets to be gifted if we're thinking about it from an inheritance tax point of view. And it's mainly at the point when someone's restricted from a planning point of view that equity release then becomes more thought about. And that's to say, if you've only got maybe taxable income from the pension to take, and then you've got a large property, and you've still got an inheritance tax liability that's large, you could think about life insurance. But if you're getting older, maybe that's when releasing some of the capital is what someone's looking to do. And I think the other key one is that downsizing, because lots of people who've talked about releasing capital from a property, they actually think the easiest way to do that is the natural way, which is downsizing. I suppose the only problem we've seen with that recently is I've had quite a few clients who've downsized physically to a bungalow, but it's actually cost them more. So they haven't actually managed to release funds from that approach.
Yeah, I think when we're looking at equity release, as we said, it's not something that you need to jump at, and it shouldn't really be your first point of call, maybe not even your second or third. Not saying that it should never be recommended. I definitely think there's places where it works. It's just a case of look all your other options, involve your full family, and who it might affect, and talk through what the options are. Because as we said before, if it is a case of you need income, there may be other places that you could get income from before you start looking at sort of withdrawing. Because as Matthew said there, you're going to be paying an interest on your property. That tends to sometimes be slightly higher than sort of standard mortgage rates. So you've got that. And then a lot of the time, because it is something that you do need to speak to a professional advisor about, a lot of the time there will be a fee involved to start up there as well. So I'd say if you can look at your other assets and work out a sort of solution from there, that would definitely be my first point of call before going down the equity release route.
Yeah, one scenario where I've seen equity release talked about is essentially someone who is expecting a large inheritance, but it hasn't come yet, and therefore they've drawn down other assets, and they've maybe factored in that when they retired, their income, what they would spend, and maybe, I mean, we don't want to talk about killing off the generation beforehand, but there's an element of going, okay, if I'm expecting to inherit £1 million, and they've then retired accordingly and drawn down on their other assets, if actually that money hasn't come through and they're getting low on their cash savings and their pensions, do they then say, okay, well, what I can do now is I can release some equity from my house, and then in the future when I get money come through, I'll pay that back, or I'll move house. The first thing I would say to that scenario is, well, have a conversation with the person you can inherit from. Do they want to lend you money? Do they want to gift money in advance? But I can see a scenario where that individual maybe doesn't want to have that conversation, so starts to explore the equity release factor. And I think the only thing that I would really, really push there is you don't want to be then stuck in a product that's going to be really expensive or you can't pay it back when money comes through the system.
Yeah, I mean, I'd argue on that one if they are relying on inheritance to fund their pension, or not pension, their retirement, then it's poor planning. I mean, separate point there. I think it's always really important to speak about potential inheritances because it can change the retirement plan. But I think it's really important not to rely on inheritance, particularly if it's a case where it's not something that's going to be gifted to you through a structured gifting plan. That can be different because you've had a conversation with them and it can almost be seen as income coming in. But if you're waiting on someone to pass away to fund a part of your retirement, you just know that by spite they're going to live till 105.
Well, it's also that sort of generational bit where maybe they're of an age where they don't want to talk about it, but actually, we don't want you to be adversely affected by not having that maybe difficult conversation. So yeah, you're right. What happens if that individual lives to 100 and care costs, erode a lot of that money, you then, you might be drawing down on your equity savings, but then you were hoping to replenish that. But if the money hasn't come, you might then be in quite a risky position.
Yeah, I mean, this goes back to the things that I think we've been speaking quite a lot about on the podcast of being purposeful with your planning. Let's imagine you are that sort of the older generation, and potentially some people might be relying on yourself to help fund their retirement. Is your money best used if you don't need it now, where you can give it to people, they may use it for house deposits or use it to structure income, or is it more useful in 20 or 30 years potentially when you pass away of old age? And I think that's something to think about and think about. If everything's sorted for yourself, then what do we think about the estate planning piece?
Definitely. And I think, again, if we think about it from the other point of view of as an inheritance tax planning tool, when and how do we use it? I think I've talked about it a lot with people as an option, and actually because of the idea of taking on debt, there's not a great appetite for it. So I think, again, it's exploring which tool to use. We know from an inheritance tax planning point of view, people can think about life insurance, they can think about gifts into trust, they can think about products that qualify for business property relief and assets falling out of your estate sort of quicker than the 7-year period. So it's almost working your way down that checklist before you start thinking, is the equity release element something I want to look at? And I think that's where, as part of a wide financial plan, looking at all the options, it can make sense. If you're wholly reliant on your property value and you're then looking to release equity from it, again, that could be a more high-risk transaction.
Yeah, and I think a really important piece here as well is to look at the sort of the other effects of equity release. So yes, there's the effect on yourself and potentially the effect on your loved ones, but equally, if you are in receipt of certain benefits that have sort of a capital limit on them through means testing, where you're not allowed to have a certain amount of cash or assets there. If you release equity from your house, which may be sort of ring-fenced from that requirement, and move it into cash, you might lose out on benefits there, which is why I think it's really important to look at that and see if you are affected with an advisor.
Yeah, definitely. And I think, in the past, when we think about the horror stories, I think negative equity was the real sort of kick, the one where, if your loved one's passed away and you say, okay, we'll sort out their estate, you say, okay, what's the property worth? If there was a debt there from equity release that was higher than the property was worth, that was going to be a disaster. And those were the ones that, hit the newspapers and really dominated the negative connotation of equity release. The good thing, when people are thinking about it now, is any product that's part of the Equity Release Council has a guarantee that there'll be no negative equity. So that they've, like you mentioned earlier, some of the regulation and some of the focus on it, they've taken away the dirty element of equity release, but maybe that name of it still has a bit of a negative view for lots of people.
Yeah, and the Equity Release Council also, you can fix rates, so you know what the payments will be over the course of the term. They can be portable between provider and provider, and you can make payments as well, sort of repayments sort of above just the interest. That if a scenario where you do come into some more money and don't necessarily need to sort of continue the equity release from your house, you could actually pay it back and reduce the cost of that. But yeah, I think sort of more generally with equity release, we need to think about sort of as with everything with financial advice, think about what we need, why we're doing it, and explore all the alternatives as well. So we're not just making a sort of snap decision because, like you said, you saw it on the telly or something like that.
Yeah, 100%. I think it's exactly that, where when we think about the products that we've talked about today, the lifetime mortgage feels easier and friendlier than the home reversion plan. It feels like the first option that you think about, and talking to an expert in the area who deals with providers, products, deals with the interest rates, has a good view on what's going to work, can help to problem solve. And we've spoken to an equity release expert in the past where, thankfully in his process, he goes through a bit like we do, fact find, looks at what the options are. And his starting point is, almost, is there a way that we can solve this that is an equity release? So again, that's showing that he's trying to, have that as the last resort. And it's mainly the, okay, well, if it comes to it, let's then get a product that isn't too expensive, that doesn't have lock-ins, that doesn't, lose too much of your property or too much of your asset. And I think that's really important for what the majority of people are trying to do.
Yeah, absolutely. And we'll finish off with a question which I think is a very valid one, and one that you might be concerned that if you are taking out equity release. We mentioned how it can be useful in an inheritance tax scenario. So as we know, we've got our nil rate band and residence nil rate band. With something like equity release, maybe if your property maybe is not worth a great deal and you release equity from the property, do you still qualify for that full residency nil rate band?
So the residential nil rate band still applies if you're leaving that asset and the value of that asset to the next generation. But crucially, you have to have that asset to the value to be able to give it. So if you were given a property that was only worth £50,000, you wouldn't be able to qualify for that full amount. If you were given a property that was worth 500,000, but then you owed 150,000 on it, you would still be able to qualify for it. So it's trying to find that balance to make sure that you're still, able to benefit from all the allowances. And again, we know that when estates get to a certain value, you start to lose some of your nil rate bands and your residential nil rate bands. So again, it's trying to have an active planning head on, and thinking about your wider allowances, your wider values, and being able to ensure that with any future regulation changes or future allowance changes, that you're always reviewing your position.
Yeah, and the residence nil rate band is obviously 175. Married couple, that could be 350. Yeah. Equity release and downsizing work in the same way. So if you were to look at that other option of, okay, you've said there you need the house value in order to benefit from it. If you did have a house that was worth £300,000, downsized to a £200,000 house to release some equity in another way, you don't lose that residency nil rate band. It's essentially pulled in by something called downsize relief, which means you're still able to pass that £300,000 down completely tax free. So that might be something, if people are considering equity release or downsizing, don't let that be something that stops you thinking, oh, well, I still need to hold the house.
And that's designed essentially for that reason, so that someone's not trapped in a big house that's expensive to heat, almost thinking, well, I need to keep this because I need to give it to the kids. It's that element that people can be flexible to move and live in the property that's right for them.
Yeah. So to summarise, I think equity release is very a useful tool that can apply to a number of different people. It, although it does have some stigma attached to it from sort of previous bad cases, the regulation and Equity Release Council have essentially come in there to try and plug those gaps and make sure that it really is sort of a proper financial product that can be used. Saying that, though, it is always something that you, as with everything in financial advice, you need to look about your goals and objectives. You should definitely speak to sort of your loved ones that might be planning on inheriting a house in the future debt-free, and then also speak to a professional, because with stuff like this, there can be little finicky bits that if you don't think about and do properly, it might have adverse effects. Yeah. Thank you very much for watching this week. If you have any questions on what we spoke about today, feel free to leave them down below in the comments, or send us an email at retirewell@wealthadvice.co.uk, and we'll see you again next week for another episode.